Hello everyone, welcome back to Financial News on Channel 4. I'm Ron Jankowski with PHTV Channel 4 and my co-host Paul Munico from Ameriprise, and I want to preempt by saying today is December 6, 2021. Paul, the days are coming quicker, faster, and soon the end of the year.
End of the year will be here.
New year.
In a blink of an eye, it'll be here.
Paul, give us an update what took place last week.
Thanks, Ron. Today we're going to talk about auto production and could it finally be on a sustainable improvement path? Let's dive into the data. The Institute of Supply Management's Manufacturing Index for November came in slightly better than expected last week. Now, November's level of 61.1, and we're expecting just 61.0, was expected via the Bloomberg consensus. Now, was the eighth reading above 60 in the last 10 months, thus representing its best stretch since at least 1983. As seen in the data, production levels picked up in November, a signal that we believe could be related to improving semiconductor availability in the autos sector. We highlight this aspect of the landscape since greatly reduced auto sales, which have been limited by availability, have been a heavy drag on economic growth lately and a leading contributor to inflation pressures. Now, improvements in auto production could materially contribute to higher consumer spending and businesses' investments in the near future, while slowly acting as a relief valve for inflation pressures. In addition to the ISM index evidence, we note that employment in the U.S. manufacturing sector was a strong 50,000 higher in November, again, according to last week's ADP report, thus continuing a recent improvement pattern for hiring in that sector. Additionally, new orders for vehicles and parts were a strong 4.8% higher in October, and that's according to the most recent durable goods report. Further, the October industrial production report showed auto sector industrial output as having jumped by a sharp 11% month over month in October. A few months of improvement still leaves the gains as tentative in our view, and the industry is still at the mercy of global semiconductor output, which is largely dependent on COVID conditions in various chip producing areas all over the globe. Overall, though, however, we do believe the tide is finally beginning to turn in the auto space, a development that, if sustained, could materially benefit the overall economic picture over the intermediate term.
Okay, that's the report, and I have a last-minute report from Ameriprise that we received this morning. The U.S. stock futures are modestly higher following a volatile week where the S&P 500 posted 4 consecutive 1% plus moves, and the VIX ended at 31. I'm not sure if the VIX at 31 is good or bad.
I mean, VIX measures volatility. We've had volatility in the market, so you're going to see the VIX react to that.
Oh, okay.
And the strong futures for Monday's opening is a welcome sign after last week. We had some down days in the market last week, and really we're not used to it. We haven't had many big down days this year.
Exactly. And Europe is trading about 1% higher midday, while markets in Asia finish lower on weaknesses in the tech shares.
Same thing we've been saying in most of our shows, Ron. We know it's a global economy. Yeah. So if Europe is trading higher, that's a good indicator that we'll probably follow suit today.
And the U.S. Treasury yields are lower with the 10-year below 1.4%, and the Bitcoin is 9% lower pre-market. Gold is flat, and WTI crude is plus 2.3% after 6 consecutive weeks of losses. Well, we did see a little bit of the gas pumps have been coming down. The cost of the the gas has reduced a few pennies, 10, 15%. I mean cents, I should say.
Yeah.
But it's now shooting back up, but shooting back up to 2.3%. That volatility could be anything. I mean,
could
there's
be
nothing
anything.
specific about oil.
It could be anything, but it could also be the start of a new trend upward. If we've trended downward, like you reported,
Yeah.
we don't know yet. You're right. It could be temporary volatility, or it could be the start of a new trend.
There's so much uncertainty, Paul. We can't pinpoint anything anymore.
No, and that's what the market dislikes: uncertainty.
Yeah.
It likes known, and then it can wiggle its way around the knowns. But uncertainty, the market does not like.
However, the year-to-date index returns are good.
They're still strong.
There's still S&P 500 is a plus 21%, Dow Jones a plus 15%, Nasdaq a plus 17%.
Nothing to sneeze at there. Those are positive, strong results.
Okay, well, thank you, Paul, for the update, and stay with us. We'll be right back with a show called Your Money. Paul usually has an excellent topic to talk about. Stay with us. We'll be right back. And we're back with Your Money. Thank you for staying with us. Paul's got an excellent topic, and this happens every year, taking steps to save on 2021 income taxes before the year runs out. Paul, I'll let you take it away.
Thanks, Ron. And again, anytime we talk about taxes on this show, we recommend and advise you do talk to your own tax advisor about any topics that we'll discuss today. Never do anything tax-wise without talking to your tax advisor first. But as topic, at the end of the year here, as Ron mentioned, something we want to talk about, things that you can do to help your taxes potentially before the year runs out. So let's dive into it. As 2020 winds down, it's a good time to assess whether there are opportunities to trim this year's tax bill. Waiting until you begin to work on your tax return in early 2022 will be too late to save in most cases. So, if you're interested in potentially saving on taxes, you should start to plan now before 2021 comes to an end. So let's consider if any of these actions I'm going to talk about make sense for you. Number one, manage your deductions. So wondering if you should itemize your deductions. For 2021, the standard deduction for a single person is $12,550. And for a married couple filing a joint return is $25,100. If your deductible expenses, such as mortgage interest, state and local income taxes, or sales taxes and property taxes, if they don't exceed that amount, claiming the standard deduction may be best for you. Now, for many people, this can be a close call. You might itemize one year and claim the standard deduction the next. To the extent possible, you may consider consolidating deductible expenses in one year to itemize and then claiming the standard deduction in the future. You'll want to think about making timely investment decisions. Buying and selling investment decisions shouldn't be based on tax considerations alone. But if you own mutual funds and taxable accounts, you may receive a capital gain dividend before year's end, which will be subject to tax. You may want to avoid buying into a mutual fund late in the year if it is on the verge of making a sizable capital gain payout. By doing so, you pick up a quick tax liability when the gain is paid, without benefiting from the previous performance that generated that gain. Now, while no one likes investment losses, you may be able to use them to generate a positive result, potentially a lower tax bill for a given calendar year. The U.S. tax code requires that losses first offset gains of the same type. So for example, short-term losses will first offset short-term gains. Because of the higher tax rate for short-term gains, focusing on short-term losses can have a more substantial effect on your tax savings than long-term losses, especially if you're in a higher federal tax bracket. If you didn't have capital gains this year, you can use up to $3,000 in capital losses to reduce ordinary income. You can carry over any remaining net capital loss to future tax years until you use that loss. Something else to consider is to maximize retirement plan contributions. Boosting your pre-tax contributions to your workplace retirement plan may reduce current taxable income while helping you build savings for the future. How much it may impact your current taxable income is based on your current tax rate and your filing status. Something else to consider is maybe taking full advantage of charitable contributions in 2021 only. An individual who doesn't itemize deductions for the tax year may deduct charitable contributions up to $300 or $600 for a married couple filing a joint return. To be eligible, contributions must be made in cash to certain charitable organizations, not to donor-advised funds for certain private foundations. Again, as always, we recommend seek guidance if you are seeking to implement these or other significant tax-saving strategies. Be sure to check with your tax and financial advisors for confirmation that the measures you are implementing are the most appropriate for you. Again, I just can't stress that enough with everyone. Anytime you're doing anything with taxes, you do need to consider the advice of your own tax advisor for your own situation before you take any actions.
Wow, Paul, there's a lot for the viewers to have to think about, and as you've already said, you should be talking to a tax advisor. Don't try to figure this thing out because it gets very complicated, especially if you had a lot of transactions and there's losses and there's gains. Let them figure it out for you accurately.
Exactly.
Thank you again, Paul. For Paul Munichla with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.